Silver just fell, not because the metal changed, not because the fundamentals broke, but because of what happened behind the scenes in the futures markets, where paper hands moved first. Right now, silver sits at 64.78, down for the day. And the question every serious investor is asking is the same one we're about to answer. Is this the beginning of a deeper correction, or the calm before silver's next major breakout? Welcome back to Currency Arc Insight, the channel dedicated to decoding the economic warnings hidden in plain sight, so you can protect your wealth before the crowd catches on. Silver moved lower today, slipping 1.62% to $64.78 in a session that erased much of the metal's recent momentum. Gold edged down as well, though far more modestly, while palladium stood alone as the day's outlier, climbing roughly $100, even as the rest of the metals complex turned red. On the surface, it looked like a routine risk-off day. Beneath the surface, something more specific was unfolding. This was not a fundamental story. Nothing changed overnight in the physical supply and demand picture for silver. Mines did not suddenly produce more metal. Industrial buyers did not cancel orders. What changed was positioning, and positioning is a different animal entirely. The distinction matters because two very different groups participate in the silver market, and they behave in almost opposite ways. On one side are the paper market participants, the traders holding silver through futures contracts and exchange-traded funds. These are instruments built for speed. They can be bought and sold in seconds, and their holders are, by design, sensitive to short-term price swings. When silver rallies hard, as it had over the prior several sessions, this group tends to lock in gains before the next headline has a chance to take them away. On the other side are the physical holders, investors who take delivery of coins and bars and store them outside the financial system entirely. This group does not react to a single red day on a chart. Their time horizon is measured in years and economic cycles, not hours and headlines. When the tape turns red, they are typically not sellers. In many cases, they are buyers, treating the dip as an opportunity rather than a warning. Today's decline appears to fall squarely into the first category. Silver had just touched a 7-week high before this pullback began, the product of a genuine rally built on improving investment demand and steady industrial consumption. A move of that speed and size almost always invites profit-taking, and profit-taking from futures and ETF positions can produce sharp, fast reversals that have little to do with the metal's underlying story. That appears to be exactly what markets are witnessing now. This raises the central question facing anyone watching the metals complex today. Is this simply healthy consolidation, the normal cooling off period that follows any strong advance? Or is it the opening move in something more serious, a shift in sentiment that could carry silver meaningfully lower before it finds its footing again? The answer will not come from today's price action alone. It will come from what happens next, from how the metal behaves once the immediate wave of profit-taking has run its course. A market undergoing healthy consolidation typically stabilizes within days and resumes its prior trend once short-term traders have exited. A market entering a deeper correction tends to keep making lower highs, struggling to reclaim lost ground even as headlines calm down. What makes this moment worth paying close attention to is the timing. This pullback is not happening in isolation. It is unfolding against a backdrop of rising geopolitical tension, a Federal Reserve that remains genuinely undecided on its next move, and a set of inflation reports due within days that could reshape expectations for interest rates almost overnight. Each of those forces is capable of amplifying today's modest decline into something larger, or just as easily reversing it entirely. For now, the metal sits at a crossroads. The 7-week rally that preceded this drop was real, built on genuine investment and industrial demand, rather than speculation alone. The question is whether that foundation is strong enough to absorb a wave of short-term selling, or whether the forces now converging around silver are enough to test it in ways the market has not yet seen. What happens across the coming sessions will determine which of those two paths silver is actually on, and the pressures driving that decision are already taking shape. Behind today's decline in silver sits a chain of events that began not in a trading pit, but in the diplomatic standoff between Washington and Tehran. Oil prices climbed toward a 1-week high today, and that single move set off a mechanical chain reaction that ultimately weighed on precious metals. The proximate cause was the collapse, once again, of any near-term hope for a U.S.-Iran agreement. Talks aimed at de-escalating tension and reopening the Strait of Hormuz, the narrow waterway through which a significant share of the world's oil supply passes, appear to have stalled entirely. The latest setback came when demands from Washington shifted the terms further out of reach, calling for compensation and reparations tied to prior conflicts and unrest. Rather than narrowing the gap between the two sides, the demand widened it, and markets responded by pricing in a longer period of uncertainty around Middle East oil flows. That uncertainty is precisely what pushed oil prices higher. When traders cannot be confident that a critical shipping corridor will remain stable, they build a risk premium into the price of crude, and that premium tends to grow the longer a resolution stays out of reach. Today's move reflected exactly that dynamic, oil climbing not because of any actual supply disruption yet, but because the odds of one occurring later have increased. From there, the mechanism connecting oil to precious metals becomes straightforward, though it is often misunderstood. Rising oil prices feed directly into inflation expectations. Energy costs touch nearly every part of the economy, from transportation to manufacturing to the price of goods on a store shelf. So when oil rises, investors begin anticipating that broader inflation readings will rise alongside it. That expectation matters enormously to the Federal Reserve, whose primary tool for managing inflation is the interest rate it sets. When investors believe inflation is likely to run hotter, they simultaneously raise their expectations for how the Federal Reserve will respond, typically by holding rates higher for longer, or in more aggressive scenarios, by raising them further. That shift in rate expectations is where gold and silver come under direct pressure. Both metals are non-yielding assets. They pay no interest and generate no cash flow. Their appeal rests entirely on their role as stores of value rather than income-producing investments. When interest rates rise, or are expected to rise, yield-bearing assets like bonds become comparatively more attractive, drawing capital away from metals that offer no yield at all. This dynamic is what makes gold and silver so sensitive to shifts in rate hike odds, even when nothing about their physical supply or demand has changed. This is the mechanism playing out today. Oil rose because Iran negotiations broke down further. Rising oil raised inflation expectations. Rising inflation expectations raised the perceived odds of continued high interest rates. And that shift, transmitted almost instantly through futures and ETF positioning, produced the red numbers now visible across the metals complex, silver leading the decline. It is worth being precise about what this sequence does and does not represent. It is not a story about silver losing value because of anything happening within the silver market itself. It is a story about a geopolitical spark originating thousands of miles from any mine or refinery, working its way through the inflation and interest rate machinery until it reaches the price of a physical asset, with no direct connection to Middle East diplomacy at all. That distance between cause and effect is exactly why this kind of move can feel disconnected from the underlying fundamentals discussed earlier, because in a very real sense, it is. The larger question this raises is how much further this geopolitical channel can push prices before other forces take over. Oil's move today was driven by a widening gap in negotiations, not a resolved crisis, which means the range of outcomes from here remains wide. And with inflation data due within days, this geopolitical spark is about to collide with a far more direct test of the market's expectations. If there is one number capturing just how uncertain this market has become, it is the current reading on the FedWatch tool, the market-based gauge that tracks probabilities for the Federal Reserve's next move. As of today, the tool shows the September meeting split almost exactly down the middle. A slim majority, just over half, believe the Fed will leave rates unchanged. Nearly the same share believes a quarter-point increase is coming instead. In practical terms, this is not a forecast. It is a coin flip. That level of uncertainty is unusual, and it matters more than it might first appear. Markets generally dislike ambiguity more than they dislike bad news. A clear expected outcome, even an unfavorable one, allows investors to position accordingly and move on. A genuine toss-up does the opposite. It keeps capital cautious, sidelined, and quick to react to any new piece of information that might tip the balance one way or the other. That is precisely the environment gold and silver are trading in right now. Looking further out, the picture shifts. For the October meeting, the odds tilt more clearly toward a rate increase, with half of the market now expecting a quarter-point hike and roughly a third still anticipating no change. In other words, the market has increasingly concluded that if a move is coming, October is the more likely window, not September. That shift itself carries meaning. It suggests traders believe the Fed needs more data before acting, rather than being ready to act on what it already has. This is exactly why so much weight has fallen on two reports due within days. Wednesday brings the Consumer Price Index, the most closely watched inflation gauge in the market, followed by the Producer Price Index on Thursday, which measures inflation further up the supply chain before it reaches consumers. Together, these two reports are widely viewed as the tiebreaker the market has been waiting for. A hotter than expected reading would likely harden the case for a September hike, pulling probability away from the unchanged camp and validating the fears already pressuring gold and silver today. A cooler reading would do the opposite, reinforcing the case for a pause and potentially fueling a sharp reversal back toward the highs seen just days ago. This is the uncertainty that short-term traders are reacting to right now, and it explains a great deal about today's price action in silver. Futures and ETF positions can be adjusted in seconds, which means traders holding those instruments do not need to wait for Wednesday's data to act. Many are choosing to reduce exposure now ahead of the report, rather than risk being caught on the wrong side of a surprise. That behavior alone, multiplied across enough participants, is capable of producing exactly the kind of pullback the market saw today, even without any change in the underlying case for owning silver. It is also worth noting what this uncertainty says about the broader economic picture. A near-even split on the Fed's next move typically emerges when incoming data has been genuinely mixed, sending conflicting signals rather than a clear trend. That mirrors what has been playing out recently, with weaker labor market readings pulling in one direction and geopolitical pressure on oil and inflation expectations pulling in the other. The Fed, and the market pricing its decisions, is caught between those two forces, waiting for one to clearly win out. That resolution may arrive faster than expected. With CPI landing Wednesday and PPI following a day later, the market will not be waiting long for the kind of clarity it currently lacks. Whichever way those numbers break, the effect on gold and silver is likely to be immediate and significant, turning today's uncertainty-driven pullback into either a brief pause or the start of something more consequential. Strip away the headlines about oil, the Federal Reserve, and short-term positioning, and a different picture of silver comes into view, one built not on speculation, but on demand that shows no sign of slowing. The clearest example is industrial consumption, and specifically the role silver plays in the global energy transition. Solar panel manufacturing has become one of the largest and fastest growing sources of industrial silver demand in the world, a trend that has strengthened even as manufacturers work to reduce the amount of silver used per panel through thrifting. That detail matters. Despite years of engineering effort aimed at using less silver per unit, total industrial consumption has continued climbing, because the sheer scale of solar deployment and electrical grid expansion is outpacing efficiency gains. Put simply, the world is building more solar capacity and more grid infrastructure faster than manufacturers can thrift silver out of the process, and that imbalance favors higher demand, not lower. China's role in this story deserves particular attention. Recent trade data showed Chinese imports of silver-bearing ores climbing more than 60% year-on-year in June alone, a substantial jump that points to significant underlying industrial and manufacturing appetite inside the world's second-largest economy. Import figures of this size are not the product of short-term speculation. They reflect real material moving into real supply chains, destined for real production. When a number like this appears alongside a week of headline-driven price weakness, it is worth remembering which of the two is more likely to persist. Then there's the gold-to-silver ratio, a figure used for decades by precious metals investors to gauge silver's value relative to gold. That ratio currently sits just below 70 at roughly 67.67. Historically, a ratio in this range has often been interpreted as a signal that silver remains relatively undervalued compared to gold, even after silver's recent rally. This is not a prediction of what happens next, but it is a data point that has stayed remarkably stable through the very volatility that has dominated the past several trading sessions. While silver's price has swung several percentage points day to day, its relationship to gold has not shifted nearly as dramatically, suggesting the recent move lower has been a broad, correlated pullback across metals rather than a silver-specific weakness. Taken together, these three data points, rising solar and grid-driven industrial demand, a sharp increase in Chinese silver ore imports, and a gold-to-silver ratio still pointing toward relative undervaluation, describe a fundamental backdrop that has not meaningfully changed in the space of a single red trading session. None of these trends reversed because silver fell 1.62% today. None of them are tied to the Federal Reserve's September decision or to the state of negotiations over the Strait of Hormuz. They exist on a much longer timeline, shaped by manufacturing cycles, infrastructure buildouts, and years of accumulated trade data, not by a single day's futures positioning. This is the distinction that separates noise from signal. A two-day pullback driven by profit-taking and rate uncertainty can happen within a fundamentally strong market just as easily as within a weak one. The forces described in the previous parts, oil-driven inflation expectations and a razor-thin Fed decision, operate on the timescale of days and headlines. The forces described here operate on the timescale of years, industrial buildouts, and structural demand shifts that do not reverse because of a single CPI report. None of this guarantees silver moves higher tomorrow, or even next week. Short-term price action will continue to be shaped by the geopolitical and monetary forces already discussed, and those forces remain genuinely unresolved heading into Wednesday's data. But for investors trying to separate a temporary wobble from a structural shift, the underlying demand picture offers a clear answer. The fundamentals that built silver's 7-week rally in the first place have not weakened. They remain firmly in place beneath the noise, waiting for the current wave of short-term positioning to pass. Every decline in silver's price forces a choice, whether investors realize it or not. That choice is not about whether to buy or sell today. It is about which category of participant an investor actually is, and whether their actions match that identity. The speculator sees silver as a trading vehicle. For this participant, price is the entire story. A rally is an opportunity to capture gains before they disappear. A pullback, like the one seen today, is a signal to reduce exposure and protect capital already earned. There's nothing wrong with this approach on its own terms. Futures contracts and exchange-traded funds exist precisely to serve this kind of participant, offering speed and flexibility that physical metal cannot match. But speed comes with a cost. A strategy built around short-term price movement requires constant attention to headlines, constant reassessment of Federal Reserve odds, and constant willingness to act on information that can change by the hour. It is, by its nature, reactive. The stacker operates from a different premise entirely. For this investor, silver is not a trade. It is a hedge, held against the slow erosion of currency value over time, against the kind of instability that geopolitical conflict and monetary policy uncertainty tend to produce again and again across decades. This investor is not asking whether silver will be higher or lower next Wednesday. They are asking whether silver and the physical wealth it represents will still hold value 10 years from now, regardless of which direction any single CPI report happens to point. Because that is the actual question a hedge is meant to answer. This distinction explains why the same piece of news, today's 1.62% decline, can mean two completely different things depending on who is looking at it. To the speculator, it is a warning sign, evidence that momentum may be fading and that further downside could follow. To the stacker, it is simply an opportunity, a chance to acquire more physical metal at a lower price, with no urgency attached to the decision because the timeline being measured is not days but years. Neither perspective is wrong. They are simply answering different questions. The speculator is asking what silver will do next. The stacker is asking what silver is for. Confusing the two is where most investors run into trouble, reacting to daily price swings as though they were long-term signals or holding physical metal with the same anxious attention usually reserved for a day trade. What makes this moment worth pausing on is that both forces, the short-term positioning driving today's decline and the long-term fundamentals discussed earlier, are real and are both operating on silver at the same time. The geopolitical spark from rising oil prices is real. The Federal Reserve's genuine uncertainty is real. And the underlying industrial demand, the Chinese import data, the gold to silver ratio, all of it is real as well. The question every investor ultimately has to answer is which of these forces they are positioning themselves around, and whether that choice actually matches how they intend to hold silver going forward. Today's dip will resolve itself one way or another within days, once CPI and PPI data remove some of the uncertainty currently driving short-term positioning. But the deeper question this moment raises will not resolve nearly as quickly, because it is not really a question about silver at all. It is a question about what kind of investor is looking at the metal and what they expect it to do for them. So as silver sits at 64.78, down for the day but still holding well above where it stood only weeks ago, the choice comes down to this. Is this a warning to be heeded or an opportunity to be seized? The market itself will not answer that question. Only the investor can, based on what they are actually holding silver for in the first place.